Welcome and welcome again to this YouTube channel. And today we have a very interesting guest. He is Mr. Ankit Himatsingka, an ex-ITC, someone who's been in the startup world and now is there to help you maximize your returns from investments. So he runs a PMS, a mutual fund advisory. We'll hear more on it from him. So welcome to the show, Ankit. Very
Thank
quickly,
you.
take us through your entire journey and how did you land up in this world of mutual funds?
So, thanks, Anurag. Thank you for having me. My journey started really in 2008, 2009 when I qualified as a CA. I did my articleship from Grant Thornton, then started working with ITC. Worked with ITC for a few years, worked with Richmond, which is a Swiss MNC. I was the finance controller for Richmond. Then got a chance to work with multiple Sequoia, which is now called Peak 15 in India. So worked with multiple of their portfolio companies as head of finance and thereafter as CFO. Uh, but I was always interested in the space of investments. Uh, I had dabbled into my own equity investments for some time, have been an active investor for almost 20 years now, and never had the courage to actually go full time into it. But thankfully, in the bull run of 20 to 25, made good money and then was able to even protect downside from the October 2024 crash onwards. So the mental models and the financial models that I was using all this while actually turned out to be really well, and they performed quite well. So yeah, in 2024, I went to Harvard Business School to do my executive MBA. The program is actually called SELP, Senior Executive Leadership Program, where I was surrounded by exemplary personalities, very high achievers. Was also coached by very established and very accomplished ex professionals, and that's how uh, the courage and I felt the timing is also right to actually take a stab at it and fulfill the purpose that I felt most close to, and which was into wealth advisory and financial services.
That's interesting. Now, you had an opportunity cost of 1 crore plus. I know this for a fact because I have handled your tax returns. So now, does this opportunity cost A hit you somewhere when on a day where you're not able to convert deals? B, when you tell this to clients, does that make the game more serious for them as well? That here there is no random mutual fund distributor or me too who's also jumped onto the bandwagon, but someone who's in here for serious business, given the kind of opportunity cost of 1 crore that he has. Tell me your thoughts about that.
So I have never explicitly told clients about the opportunity cost that I have for running this venture of mine. But yeah, of course, having credentials and telling them what I was doing and what is my background actually establishes trust. Today we have been able to garner some AUM, which in last 6 months I would say is higher than the average that most people would have done in this time frame. And I think that is because not just the quality of advice that we are able to bring to the clients, but also because it brings confidence in them, it instills confidence in them that we have been following a certain pattern, a certain investing style that has worked for us, and for a certain value of AUM that we manage for our own prop book. So that prop book actually gives confidence to them that what we are saying is something that we have lived through it and we are living through it.
Fantastic. Ankit, I like your tagline on LinkedIn that let's talk if you hold more than 5 mutual funds or you've earned less than 30% IRR from mutual funds over the last 5 years. Now, is this a very cheesy kind of a tagline to attract people? What is the fundamental thesis behind this? Because I analyzed my mutual fund portfolio after seeing your tagline. I had some 37 odd funds in that. So, and my IRR is nowhere near 30%. It's less than 15%, for example. So, does this really make sense? 5 funds, 30% IRR, or is it just a promise for onboarding people?
No, it actually makes sense, Anurag. I'll tell you. how the genesis of these numbers actually came out to be. If you really take a customer's journey today, uh, there is a goal based investing, and I fully subscribe to goal based investing. But for most people who are in their early 20s or even early 30s, their most goals are a decade away from them, or maybe even longer. Now, in that scenario, what we see is that most clients, the way they invest into mutual funds is by looking at five-star rated funds, four-star rated funds of the prior period. So they would visit some website, they will look at five-star rated funds and then invest into them. Now, across the industry, everyone knows that past performance is not a good indication of the future results. But unfortunately, the ratings are also given by a heavy weightage of past performance. For example, if you go to 2019, Nippon India Small Cap Fund was one star or two-star rated fund for most websites. But in 2020 to 24, the fund outperformed the markets by leaps and bounds. And that led the fund to be now called a four-star, five-star rated fund by most websites. So if an investor was taking that call in 2020 by looking at past return, he would have not got Nippon India in his portfolio, Nippon India small cap. And today, if an investor buys Nippon India small cap, he may be in for a rude shock because the valuations in small caps have gone up very high. Now, the aspect that I'm trying to get to is most people invest by looking at past performance or new fund offers or thematic, etc. What it does is each fund, even if you assume holds 10 to 15 unique stocks in its portfolio, and if you end up having 10 funds in your portfolio, you end up having 200 funds. Whether you slice it by saying, no, I have some large cap, some mid cap, some small cap, assuming again, if broadly the distribution is the same, you're essentially holding NSE 500, then you can't expect a very high return from that portfolio, because what you're doing is your portfolio is over diversified. Mutual funds by design and by nature are supposed to give you diversification, but by holding too many mutual funds, you are overkilling the diversification part. So that's why we said five funds or less than five funds, tightly managed, can actually give you better returns than holding funds basis past performance. Now, coming over to the 30% part, if you look at, and this tagline was written a couple of months ago, uh, at that point of time, if you had looked at the Nifty 50 return or mid cap return for any of the good funds or even indices like mid cap, BSC mid cap index or Nifty 50 index, those indices themselves had delivered 20-25% CAGR. So what is happening is there is a lot of recency bias in the minds of the investors, where they see, let's say, 25% CAGR in their portfolio if they had started investing after 2020, and they feel that they have done a very good job without realizing that actually the index itself had given that kind of a return. So unless you have been around for 15 years and you have made 20% return, that's a great return to have. But if your recent 5-year return is less than that, then probably you have not made very high return compared to the index. And therefore, again, the need to relook at your portfolio to see what are the right funds to hold. Because again, overkilling and over diversification does not help in this case.
So your approach is kind of a PMS approach towards mutual funds. So you're investing in, let's say, an HDS or a Kotak, but it is kind of a PMS style. How different is this style from conventional approaches?
So again, how it started is because we run a PMS as well. Now, a lot of clients are not in that space yet where they can commit a 50 lakh rupees investment for a PMS, which is the minimum requirement for SEBI. What we try to offer in that case is, in our PMS, we also kind of follow sectoral themes. So we try to find mutual funds which closely resemble the portfolio of our PMS and help the clients invest into those mutual funds which follow those sectoral themes. For example, defense was a very good theme at some point of time. Healthcare is a good theme to invest into right now. IT was a very good theme at some point of time, maybe a good contra call right now. So we accordingly look at those funds that have similar theses as we are following in our PMS, and we help the client to invest in that and rebalance it on a long term basis, being mindful of the exit load, being mindful of the short term capital gain tax, etc., to help the client maximize their return through the right mutual fund investments. So that's how the it's a PMS style of investment, where we are not telling them to buy and forget, but actively look at the portfolio and not going by purely the ratings of the funds, because ratings are always looking back in the past. Mute. You're on mute.
Yeah, so ratings are basically a performance. Past performance is what they consider for the
Correct.
ratings. They
It's
are
not
not
a leading
forward
indicator,
looking.
it's a lagging indicator.
Okay. So what have been your initial insights as you plunge into mutual fund industry or PMS full time as a professional? So what are the typical mistakes that people make when it comes to their investing?
So, with regards mutual fund investing, the most common one, like we spoke also, is that people tend end up amassing a lot of funds. There are people we see who are still continuing their investment in ELSS funds, knowing fully well that ELSS funds actually don't deliver the kind of return that their risk profile actually wants. They would have invested in those funds because there was an old tax regime and there was some tax benefits there, right? There is a lot of inertia in the investors that we see, because sometimes even when they see that the fund is underperforming, uh, there is no hand holding, there is no guidance to the investor about taking that call to whether to actually exit from the fund or to continue being in the fund. So that inertia kills a lot. We meet a lot of clients. In fact, one of the clients works with a VC firm, very large ticket investor, holds over 1.5 crores in mutual fund, just a 27-year-old person, but again has 37 funds in his portfolio, because every time there was a new fund or a new five-star rated fund, he would invest lump sum into that fund, right? Now, you would tend to imagine that a guy who works with a VC should be very, very well versed with finance and very well adept at
Absolutely.
these things, right? But then it does not translate well into personal finance. While he can evaluate companies very, very well for his investment portfolio of the VC, his own personal finance is a little bit scattered because of inertia of doing things.
Oh, I completely agree because there was a time in my life, every time I saw a five-star fund, I would start an SIP of 500 or 1000 rupees on that. And just
Yeah,
to get that dopamine that, yes, I am part of something big which is happening. But eventually it becomes too large to manage. Now, you also deal,
absolutely.
Ankit, with a lot of HNIs, a lot of NRIs. Now, the people watching this show are mostly the common folks, the Aam Aadmi. Now, how do the HNIs think differently as compared to the common folks? So, if you have to segment people into the suave ones and the ones who make these hurt behavior driven mistakes. So, what are your behavioral finance insights that you draw from society's different stratas?
Mostly we see wherever we manage or advise family offices, or we advise large HNIs, they have reached a point in their wealth creation journey where protection of capital takes a large precedence over growth of capital. So there the approach is very different. They are not chasing small caps, they are not chasing big caps, they are not comparing the return of a PMS to a mutual fund, right? What they are looking at is essentially, let's say, a PMS provider who they can talk to, they can understand why the PMS fund is actually taking exposure, and what is the downside capture ratio of the fund. How is the fund behaving in terms of volatile times? What is the net outcome that they're getting? Is it thesis backed, etc.? So unlike a common person who would look at just returns, they are actually going into the causality of the return and the replicability of that process. For example, a very large fund today, if you look at one of the largest funds in the market today, had a very high CAGR from 2019 to 2020 to 23. But if you go deeper, you'll realize that the CAGR was because the fund had high exposure to NASDAQ, and it was amongst the pioneers in Indian industry to actually take exposure in NASDAQ at that point of time. And NASDAQ did, as we all know, exceedingly well, and was coming out of a of a large consolidation of almost 14 years. And that's why that return was generated for the fund. But if you look at the more recent performance after SEBI intervened and asked them to reduce the exposure to Nasdaq, because uh, industry wide limits were imposed, the return of the fund is now very much similar to its peers. So if you were to just go at 3 year, 5 year, 7 year CAGR, you'll find that the fund is an exceedingly outperformer fund, right? Because you are looking at something which is not being replicated today. So at an HNI level, we go much deeper into these aspects of fund performance rather than just the CAGR number.
I remember you had written a post on Parag Parekh fund also. I think that is what you are referring to because that also had
Yes,
historically very high returns. But now going forward, because of this Nasdaq thing, they might not really be able to replicate that success story, right?
absolutely, absolutely.
Brilliant. So, could you talk about your process for mutual fund selection and timely rebalancing? Because I think your thesis is that it is not just good to select the right funds, but also keep rebalancing them with developments, let's say a fund manager's exit, etc. So tell us, what should be the Aam Aadmi's approach to fund selection, to rebalancing with or without a consultant? So what are the
Yeah.
parameters that one must look at?
So the first and foremost parameter we look at is overvaluation or valuation in particular sectors. So at any point of time in the market, there are always opportunities. Whether the opportunities lie in large cap, mid cap, or small cap is a different matter to discuss, but there are opportunities in the market. A fund which is a large cap oriented fund will never outperform the markets in a first stages of the bull market, whereas a small cap fund will always have a higher drawdown than its other large cap peers in a very overvaluation market. So our first and foremost thesis is to look at where the valuations lie. Once we have gone through that, we look at more consistency of returns rather than CAGR. So we would only look at funds that have at least 10 years of history. Anything which is less than 10 years of history, we don't look at. We don't look at NFOs at all. We don't look at thematic funds at all. And the logic for that is that any which way in India currently, there are hundreds and hundreds of funds. Whichever type of allocation you want, you will find a fund. There is no reason for me to bet on a NFO when it does not have a track record. There is no compelling uh, nature of investment that the NFO can do, unless, let's say, for example, SIF is coming. Those will be NFOs, so we'll take a look at them. But otherwise, there is no compelling reason for them. So we look at those kind of parameters or 10 years return. We look at not just CAGR, but in how many years the fund has actually outperformed its benchmark, right? What is the standard deviation of the fund? How much does it have a downside capture? How much years of experience has the fund manager in that fund, rather than just looking at, for example, I may be looking at a fund with 10 years of history, but the fund manager running the fund may be 6 months into this job. He may have moved from somewhere else. So then we are not comparing the fund return to the right fund manager. So that mapping is also equally important.
Okay. Give us some specific examples so that one can really understand what you. So give us some classic example that hey, there was this fund manager who contributed to this performance. Now this fund manager is no longer there, and hence now this fund should not be looked at.
So I'll not go into that really about fund manager, but I can talk about the other aspects that we discussed, which vis-a-vis, for example, one of the funds, and it's not a recommendation. I'm just mentioning the name of the fund for the benefit of the listeners. One of the fund we really like is Invesco India Midcap,
Hmm.
and we actually recommended Invesco India Midcap to a lot of our investors when the fund was actually 3-star rated fund. Now it has been upgraded to a 4-star rated fund. The thesis that we followed was, if you look at the portfolio of the fund or the performance, even the performance of the fund, in the last 10 years, 10 calendar years, the fund has outperformed its benchmark in 7 to 8 years. Although the overall CAGR may not look very attractive, but the consistency of returns that the fund has given is exceptionally high, and the standard deviation of the fund is lower than the CAGR that it delivers, which means in downside market, when I want to withdraw the money, I will not be faced with a situation where I have lost 2 or 3 years or 4 years of return because the markets are down and the fund is too volatile, right? Other aspect is also, we don't recommend funds that have had any recent or even slightly dated issues with regards corporate governance like fund running or questions being asked by SEBI, etc., or where they have not been able to liquidate their positions on time, etc., we tend to avoid those funds also. uh, so these are some broad frameworks that we follow for our investing.
Okay. And nowadays, a lot of people talk about automated portfolio solution that I just upload my portfolio on an app. The app gives a portfolio solution. As compared to that, going to a personalized advisor like an Ankit Himatsingka and getting advice on my thing. What do you think would be the pros and cons of this?
See, of course, a lot of these platforms claim to use AI at the back end or some logic behind at the back end to actually do this. um, my view is that with AI, the democratization and access of information will definitely increase. However, for an investor who always wanted to investigate or find out about funds, there were enough and more sources of data already available in the market. The information asymmetry in this field has been reducing over time for a very long period of time. And while these new age platforms have come up, there are existing old platforms also that have been doing this activity where they have been suggesting people about their funds. They used to pull up data from CAMS or MF Central, etc., and give some recommendation to people about the fund. The question is not about quality of fund, etc. That is just one part of the entire puzzle. I can always recommend you some fund which is a top performing fund today, or I can always tell you to not invest in some fund. The quality of advice that comes is more behavioral finance, right? Understanding, for example, again for HNI clients, understanding the client's needs. A client may say that he can undertake volatility, but can the client really undertake volatility? What is the time horizon? What are the cash flows the client is looking at, right? So giving the client a mental framework really, and helping the client work through that framework to be able to actually help the right investment pattern for the client is what a human brings into the element. So I believe that AI will make task very easy for any advisor. It will also probably help a client who's just starting out in their journey. But once you have amassed a certain level of wealth, at that point of time, you may want a sounding board for whatever the AI is suggesting. Because at the end of the day, AI will not give you prescriptive solutions, it will give you some guidance. And if you want a sounding board, then a human advisory layer on that will always be helpful for that.
Fair point. Nowadays, the flavor of the season is multi-cap funds, flexi-cap funds. What is your view that are they the right method for wealth creation, or are index funds the right method for value creation, or a mix of them?
So I think multi-cap funds and multi-asset funds actually are a very good addition to anyone's portfolio who's again just starting out or very risk averse, because what you're doing is essentially trying to leave that in the hands of the fund manager to decide which way the market is and accordingly take a call. uh, the only and only downside for multi-cap funds especially could be that again the fund manager, because of taxation reasons, etc., the way regulation works, they cannot reduce their exposure from equity completely, because otherwise if they do that they may be classified as a debt fund, so they have to remain invested in equity up to a certain limit, right? Which again, as an individual investor, you may be able to prune your exposure as you see market conditions to be suitable for that. Versus index funds, we again believe that even today in India, there is a lot of information asymmetry, which which a fund manager can utilize to deliver outstanding returns. While the historical data available has become democratized, there are many other parameters of how a particular industry or how a particular promoter will behave that a human can understand better and can bet on better. And Anurag, more than me, you have spoken to so many founders in the startup ecosystem, in listed companies, etc. And you would know that the growth of a company is not just linked to the industry, but also how hungry the promoter is, right? And what is his vision? Finding out those kind of situations that we do, for example in our PMS, is also very important aspect of predicting the growth of a company, and an index does not always necessarily capture that. So in a very mature market where a few stocks garner the largest size of the market cap in that market, an index will give you good returns. But in a country like India, active fund managers, whether it is mutual fund managers or PMS or AIF managers, will still have a lot of runway and a lot of headroom to actually deliver better returns than indexes.
Okay. Lump sum or SIP?
Depends on what kind of money you are having. If you are a regular income salaried person, definitely SIP. You get the benefit of averaging. But if you have got into a lump sum money, at least in today's market, I would not ask you to invest it together, but also not ask you to wait for the dips and corrections. Enough and more studies have shown that waiting for correction, more often than not, makes you invest at a higher level rather than at a cheaper level. There are, statistically speaking, in India, there are more number of days when Nifty has been higher than the preceding days. There are more number of weeks, more number of months when Nifty has been higher than the preceding month or week than it has been lower. So if you're staggering your investment for too long, lump sum investment or too long, you are likely to buy at a higher cost than at a lower cost.
Large size AMCs, an HDFC, a Kotak, an SBI, or the small ones, an Invesco, a Canara Robeco of the world.
I would say rather large, long vintage fund with the right fund manager. It does not really matter whether it is a large size or small size. Size, I don't think matters in this case, because again, like we said, we discussed, it could be that you are going after the largest size AMC, but the fund manager himself is not that experienced, or the fund manager's past performance in a previous role was not that great.
Okay. And so the key here, I would imagine, is to also keep a tab on these fund managers, how they are shifting loyalties, and accordingly, you also shift loyalties.
Exactly. Or if even if you're not shifting loyalties, put a red flag against that and re-monitor your portfolio more often than you would.
And trust me, most of us, the Aam Admis, do not know who are our fund managers and whether they've actually continued with the AMC from the point where we made the investment. And I'm sure there must be a lot of this churn in this mutual fund industry. Also, people would be shifting loyalties, etc. And that is where I think the role of an advisor comes in, where you
Yeah,
guys will actually monitor the movements and accordingly advise clients.
absolutely.
Any book that all finance professionals, enthusiasts, someone wanting to enter the world of investing must read?
I think there are a couple of books that one must read. Most of us may have heard of Morgan Housel. Morgan Housel has written three books now. I think all three of them are very good in their own way. I also really like this book, which is not purely investing, but it's about generally behavioral finance, and how our behaviors are shaped by different external factors. And this book is called The Molecule of More by Daniel Lieberman. um, I think that's also a very good book to generally understand how we as investors and human beings behave in different market situations or when faced with different situations, and that itself will make us better investors.
Mutual fund, is it like sure shot 12% kind of an FD, or is there a myth about mutual fund that you would want to debunk on this podcast?
That There are two aspects to this. Again, one aspect is, theoretically speaking, if you assume that all companies in a country by and large represent the GDP of a country, then in a country like India, which has been growing at 6, 7, 8% depending on different time periods, at real terms basis, you add um, inflation to it of about 4 to 5%, you get to a nominal growth rate of about 11, 12%. Now, again, like I said, that if you assume that all companies are by and large a good representation of the country itself, then ideally, if the GDP grows at a certain pace, you should always get that return. But this is again assumption and theory. There have been periods in the past in developed markets and in India where you have got zero return for a decade. If anyone were to look at S&P returns in 90s, or look at you look at Nasdaq example from 90s, and then even in the early 2000s, etc., the returns were very bad. Even in India, pre 2020, of course, post 2020 we have had one way rally. But if you go pre 2020, there have been 3 years, 4 years bouts when we have got zero returns. So given a country's valuation, you may come across a time period when you will not even get those 12% returns from a mutual fund.
Mm.
But if you hold long enough, and if the country continues to grow and there is no root shock to that growth path, then you can expect that the valuations, the multiplier to the GDP, etc., and the discounting that people are
Mm.
doing or investors are doing for the future growth remains constant. So you will continue to get that 12% return.
One quick question, Ankit, you operate out of Gurgaon. There is a real estate boom in Gurgaon. डू यू ऑफन फाइंड दिस क्वेश्चन, यार ये म्यूचुअल फंड वगैरह मुझे नहीं समझ में आता है, ये ना 10-12% नहीं चाहिए मुझे, तो डबल चाहिए एकदम क्विकली, प्लॉट खरीदा रोहिणी में एंड डबल हो गए 2 साल में पैसे. डू यू ऑफन फेस दिस काइंड ऑफ क्वेश्चंस आल्सो फ्रॉम योर HNI clients?
Actually, it is the contrary. So a lot of clients have lived through this, where now they have equity as well as real estate portfolio, and in the last decade or so they have actually made better returns in equity, and they have faced the illiquidity of real estate and all the hassle of managing a real estate portfolio with
हाँ.
regards managing a tenant, or if it's a vacant plot, then always living with that fear that what is the status of my plot, is there an illegal occupation on the plot, how do I sell it, where do I find a buyer, if I need a fund immediately, what do I do with that, what about the taxation, I can't withdraw partial amount from it, so the plot may be of 1 crore, but if I need 20 lakhs, what do I do with that, I can't
हाँ.
sell I mean, either I fully liquidate or I don't liquidate, right? So more often than not, now we see that people who are exiting their real estate portfolio are also coming into equities. In fact, elderly people in the age group of 50s who have multiple real estate portfolio are saying, I don't want to live with this hassle in my golden years. I don't want to manage 6 7 properties. I don't want tenants, the headache of finding another tenant or this tenant not paying me on time, etc., etc., because my kids also are not here, they don't have the bandwidth to do all of this. I would rather consolidate all of this and put it into liquid investments.
That's an interesting perspective, and it's music to my ears because I've consciously stayed away from real estate for the sheer reason, as you outlined. What if the plot gets some unauthorized intrusion? What if the tenant does not vacate? And I would rather imagine REITs to that extent are slightly better in this regard. If you, for example,
Yeah.
look at the recent REITs, which are, for example, a knowledge realty trust and all, which recently came, you have well managed, actively managed portfolios of real estate. Ankit, as we head towards the close of this wonderful podcast, you've been here in this industry, I would imagine, 8 months now since you
Yeah.
quit your job. One very memorable moment where a client tells you, अंकित साहब, आपका जैसा तो मैंने advisor कभी देखा नहीं. And what had you actually done for that kind of a thing, that where people actually felt that yes, there was a difference, the clear value add was there, instead of an agent just coming and trying to give you the regular plan and have his share of the flesh.
I think one very um, cherished client that I have is a friend with whom I had lost touch with. We were in ITC together. Our periods overlapped in ITC for a brief period of time, and we lost touch for almost 15 years. He's now settled abroad, doing very well for himself, has amassed a lot of wealth, has investment properties across the globe, I would say, not just in India but in Dubai, in Africa, has a lot of investments. And he saw my posts on LinkedIn, and we reconnected, and he had some surplus cash. His first thought process was, am I ready for retirement and am I ready for my goals, right? So we walked through his entire portfolio, uh, gave him, and he's a chartered accountant, right? So he understands finance very well. But he wanted again a sounding board from a second party who can take a neutral, unemotional approach of where he stands financially. And from there, he invested in the PMS, he invested in mutual funds, and now has got to a point where we chat up early mornings on Sundays before he goes for his paddle games, which is 6:30 in his morning and 9:30 our time, just talking about various stuff. So of course he was a friend earlier, but now the relationship has gone much beyond just advising him on his PMS or his mutual fund portfolio, but his holistic aspects of investments on NRI FDs, or his other property investments, or his investments in the US and Canada markets. So it's much beyond that. So I
Hmm.
really cherish talking to him in that sense.
Fantastic. So, final thoughts, Ankit, as this is the final question. Your last 60 seconds to make an impression on the audience. Alpha Square.
I would say if you have been investing yourself, that's a great start. But if you have really not had a look at your portfolio and compared it to the past performance, or not had a look at your portfolio to see what the gaps are, it would be worthwhile to go to any advisor and talk to them. Whether it is Alpha Square or not, I will not make that pitch. But I would say speak to an advisor and see what kind of a value they can bring, right? Whether it is an RIA or an MFD, it does not matter. But a third party who is full time into this can add a lot of value. You can always buy a paracetamol at the recommendation of ChatGPT, but when it gets serious, would you still go to ChatGPT to actually get your recommendation? Is a question that you have to answer for yourself.
And disclaimer, Alpha Square has not sponsored this podcast. And this is purely for educational content to help people understand that how to look at their investments in a very structured manner. Thank you so much. If you've come so far into this podcast, I'm sure you would have got some very, very structured insights, something which the normal MFD would not be able to give you. Thank you, Ankit. Thanks again for coming on this show. Bye.
Thank you, Anurag. Thank you.